Chip stocks just bounced back hard this morning. The Nasdaq jumped at the open, the Dow briefly crossed 53,000 for the first time ever, and the financial headlines are calling it a recovery. But here's the problem with that story. A bounce and a recovery are not the same thing, and the difference between those two words could cost you real money if you misread what is actually happening right now. Let me show you exactly what the data is telling us today. This morning, the S&P 500 opened nearly flat at 7,483. The Dow surged over 594 points, crossing 53,000 briefly. That is a milestone worth noting. But the Nasdaq fell 207 points simultaneously, two major indexes moving in opposite directions on the same morning. That is not a unified market rally. That is a rotation, and rotations tell you far more than rallies ever do. Last week, semiconductors dropped over 3% in a single stretch. Analysts at Charles Schwab called the AI sentiment around chips sour. Their own derivatives research director said positioning in the space had become lopsided. That word matters. Lopsided means too many investors crowded into the same trade. When a crowded trade starts to unwind, it does not unwind slowly. It snaps. And that is exactly what happened to chip stocks last week. Now today they are bouncing, but watch carefully at what is actually leading. The recovery is not broad across the entire semiconductor sector. It is narrow. Specific names are being bought aggressively. Others are being left behind entirely. That gap between winners and losers inside the same sector is the signal worth paying attention to. Here's what the rotation actually reveals. The AI chip trade that dominated 2025 and early 2026 was built on a single assumption. More AI spending equals more chip demand equals higher prices for every semiconductor company. That assumption is cracking, not because AI spending stopped, but because the market is getting smarter about which companies actually benefit. High bandwidth memory chips, the ones physically embedded inside AI processors, still have structural demand. We covered Micron's blowout quarter recently for that exact reason. But the broader semiconductor index contains dozens of companies that are not in that supply chain. Older chip architectures, companies serving consumer electronics rather than data centers. Those are the names being quietly left behind even as the headline sector bounces today. Now hold that thought for a moment, because there is another number from this week that puts everything in sharper focus. Small cap stocks just delivered their best first half since 1991. That is not a minor footnote. 1991 was over 35 years ago. Think about what that actually means. While AI mega-cap chip stocks were getting battered last week, smaller companies were quietly posting extraordinary returns. The rotation out of semiconductors we saw last week did not send money to cash. It sent money to small caps. That tells you institutional investors are not pulling back from risk. They are repricing it, moving from the crowded mega-cap AI trade into parts of the market that actually benefit from falling interest rates and domestic economic strength. And that brings us to today's bounce. When chips recover this morning, ask yourself a simple question. Is this new money coming in? Or is this the same money that rotated out last week, briefly rotating back in before moving on again? The answer matters enormously for how long this bounce lasts. If you are finding this useful, consider subscribing for more practical financial insights. The market is moving in ways that headlines miss every single day. Here's the framework that helps cut through the noise. There are two types of sector pullbacks. The first is a healthy consolidation inside a strong trend. The sector gets overbought, pulls back, and then continues higher. The second is a structural rotation where capital is permanently repositioning away from a theme. The first type rewards buyers on the dip. The second type punishes them repeatedly. So which one is this? The Schwab research team gave a useful clue this morning. They said the recent weakness may be wringing out excess positioning rather than signaling a trend reversal. They also pointed out that the broader market rally is still expanding beyond AI. Economic data remains strong. Second quarter S&P 500 earnings growth is projected at 23.3% year over year according to FactSet. That is not a recessionary backdrop. But here is the critical detail most investors are glossing over. Strong overall earnings growth does not mean every sector participates equally. It means the companies with actual earnings power get rewarded, and the companies that were priced on hope rather than revenue face a reckoning. Inside semiconductor stocks, those two groups now look very different from each other. Let me give you a practical example of how this plays out. Imagine two chip companies. Company A makes the memory chips that go directly inside NVIDIA's latest AI processors. Their order book is locked in for 18 months. Company B makes chips for smartphones and gaming laptops. Consumer demand is soft. Inventory is elevated. Both companies are classified as semiconductors. Both show up inside most index funds under the same sector label. But their financial realities right now are completely different. When someone tells you chip stocks bounced today, they are averaging those two companies together. That average number hides the story. The actual story is that one of them deserves to bounce. The other one is just being carried along by the headline. Now here is what this means practically for different types of investors. If you hold a broad technology ETF, some of your money is in both companies. The ones with genuine AI data center exposure will likely recover and continue. The ones exposed to soft consumer tech demand face pressure for the rest of 2026. The job right now is not to guess whether chip stocks recover. The job is to understand which chip exposure you actually hold. For investors who have not looked inside their ETF holdings recently, today is a reasonable moment to do that. Most major brokerage platforms let you view the top holdings of any fund in seconds. It takes less time than reading a market recap, and it tells you far more. There is a broader lesson in today's market open worth internalizing. The Dow crossing 53,000 is a real milestone, but the Dow is 30 stocks. The fact that it surged while the Nasdaq fell on the same morning tells you the composition of today's strength matters. Industrial stocks and blue-chip communication companies led the Dow higher. Technology and chip names held the Nasdaq back. That split is exactly what a rotation environment looks like in real time. The second half of 2026 is going to reward investors who read the rotation correctly, not the ones who bought every chip dip assuming the first half playbook still works. The market is repricing AI exposure from quantity to quality. Broad sector bets worked in 2025. Specific exposure decisions are what matter now. That is what the data from this morning's open is actually showing. What you do with that information is up to you.